Hi members, and welcome to our latest Smart Investor session. My name is Mitchell Sneddon and I am InvestSMART's Head of Portfolio Services. So today what we're going to be going through is how I look at selecting a passive investment product. Now when I say passive investment product, I don't mean passive from the point of view that that the holdings underneath in it don't move or don't change. I mean passive for you, the investor. So something like a managed fund or a listed investment company or an exchange traded fund or separately managed account where you buy into it, you select say 2 or 3 of them, buy into it, you put it in the bottom drawer and then you bring it out say every 6 months to check on it as you go about your daily business. So that's what I mean when I say passive investment product. Now, just starting out here, the reason why I'm talking about it today, previous to my role as the head of portfolio services here, I was a Eureka Reports listed investment company specialist. So I looked specifically at listed investment companies. So really what that was assessing were how fund managers themselves, how to select between them. And prior to that role as well, I was working for a funds management company where we did have a listed investment company. We had a managed fund, we had individually managed accounts, and we were operating the same investment model, so the same model portfolio across all 3 different types of structures. And all 3 had slightly different outcomes, and all 3 suited different types of investors. So you needed to know which one was the right product for you. So that's what I'm going to be talking about here today. Now, as always when we do these live events, you've got the ability to ask questions as we're going through. So just beneath the video box there, you can see where you can enter your name and then put some questions in as well. Now, if you do wish for a copy of the presentation once we're finished, also submit your email address in the question box. Don't worry, we won't hit publish on your email address, but we'll have a record of it there and we'll know that you want to have a copy of the presentation emailed to you once we're finished. So I'll move on to my very first slide of the day and my most important one as well. It's our disclaimer. So I'm going to be talking about managed funds, we're going to be talking about listed investment companies, we're going to be talking about separately managed accounts and exchange traded funds. Now, of course, I don't know your personal circumstances, so this information is general in nature only. So do take that into consideration when viewing this. And anything I do say during the Q&A section as well, do take as general advice only. And if I get carried away, I'll probably put that slide back up a few more times throughout the presentation. Now, on to the next slide after the disclaimer here, and I've been doing this presentation around the country actually. I've been to Brisbane, Sydney and Melbourne, Adelaide and Perth last week as well to do this presentation in person. And as we've been doing it, I've done it to approximately 400 people now. Still a lot of questions come up about how everything fits together here with InvestSMART, the Eureka Report and Intelligent Investor. So I just thought I'd take a couple of minutes just to cover that off for you. Now, no matter where you originally started, if it was with the Eureka Report, Intelligent Investor or InvestSMART, your login to the Eureka Report will actually work on all 3 websites. Or if you came from the Intelligent Investor, that login will work on all 3 websites as well. So you get access to all of the services. Now, the Eureka Report is going to stick to what it does best, and that's its superannuation and tax advice. You might have recently seen some live Q&As that we've had with Max Unum and Bruce Bremmel, our tax and super advice experts. Also, it's going to stick with its macroeconomic coverage with Callum Pickering and Robert Gottliebsen, of course, writing that. And then the Intelligent Investor side, we've got some very staunch members there who have voiced their opinion to us, and they do not want the Intelligent Investor to change, and we're not going to change it. It's going to continue to do its buy, hold and sell recommendations and its actionable investment advice, and then some bigger picture investment trends. So that will not be changing whatsoever. Now, this next slide on though, it shows you what InvestSMART, the website, really is. And it's the central location. Now, I actually spend probably 90% of my browsing time when I'm going across the 3 sites just on InvestSMART. And the reason for that is no matter where something's published, if it's Intelligent Investor first or Eureka Report first, it'll feed up into InvestSMART. So I call InvestSMART the central hub, and the reason I call it that the central hub is because it's also got my portfolio there. So my portfolio of stocks and investments sits within InvestSMART, and then I can easily go and see the reports on stocks that I specifically hold. So for me, that's really easy, really handy. Now, also, if you haven't done so already and you are an InvestSMART or Intelligent Investor and Eureka Report member, do go out and download the InvestSMART app. The reason why I say this is because if you are following our stock recommendations, they will, and say you're wondering if you'll miss a change in recommendation, if you might be on a holiday or away from your computer and you don't see emails come through, or you're not regularly on the website, the app will send a push notification to your phone letting you know when we've changed a stock recommendation. So you will never miss when we change a hold to a buy or a buy to a sell. You will never miss that. So do keep an eye out on the InvestSMART app. Download it if you don't have it, and it's really handy to read the articles as well, especially when you're, say, on public transport, as I find myself quite often. So with that aside, we'll go straight on into my next slide here. Now, this slide, I think, sums up why this actual presentation is quite important. Say, for example, you're transitioning to retirement, you've got a self-managed super fund set up, and you think to yourself, I'm going to buy into 2 or 3 managed funds, get a couple of ETFs for my core portfolio, and then set and forget, and away I go. Well, you're kind of confronted with a fairly daunting outlook. I jumped onto Morningstar not too long ago and checked out and did just a really basic search. And what I found were 9,317 managed funds, 151 exchange traded funds, and that number is only growing, and 93 listed investment companies. Now, this is a few weeks old, this data, so 93 listed investment companies could very well be 94 or 95 or even 100 by now, because I tell you what, they're coming onto the market rapidly. So it's a very daunting task just picking 1 or 2 from these. Now, the 9,317 managed funds, they're not all Australian equity managed funds. They're like, say, Australian equities, international equities, property, etc. But when you think about it, it's probably even easier just picking a couple of stocks, because there's only 2,000 odd stocks on the Australian market, let alone the 9,317 managed funds. So that's why I think this topic is pretty important. Now, on to the next slide. What we're looking at here today and how I assess an actual managed product. I'm looking for 3 things: the people, the process, and the product. So the people are who's behind it. The process, how do they make their money for you? Very important, believe it or not. And then the product, how's it actually delivered to you? Because something that's going to suit me might not be suitable for, say, someone who's 80 years old and living off their super fund. They're not contributing to it anymore like I am, but they're actually just drawing down from it. So the products that's going to suit me, I might have a bit more flexibility in choosing my range of products, and someone else might really need something that is able to provide for them. So that's what we're going to get into. Now, so moving on to the people first. Now, I just wrote down a few little dot points here on this slide when I'm looking at assessing people. Now, the very first dot point relates to what I call what's known as key man risk. I do not want to be investing in a portfolio or product where it's, say, run by a 1-man or 2-man team. I don't want that, because what happens if that person steps out on the Collins Street down here in Melbourne, where we're located, and gets hit by a tram? Then my investment case, my investment with them is done. It's over. But so what I'm looking for is a depth in the team, and hence why I say, can you name the chief investment officer or portfolio manager? Now, a very recent event that took place was, say, with Hunter Hall in Sydney, where Peter Hall, the founder and chief investment officer, emailed his board and on Christmas Eve and said he didn't want to invest anymore. He didn't want to be a part of the company, and resigned on the spot. Now, for me, where he was such a key integral part to that investment process, that represented strong key man risk. And if you've been following along with that story as it's unfolded, it's gotten pretty ugly. So secondly here, I'm looking for the team's experience. Now this is really important to me when I am looking at a new product, because there's plenty of them coming out there on the market, and just because they're new and just because they don't have a track record doesn't mean they're not worth you having a look at. Now, what I'm looking for here is at least seeing a good depth of experience in the team as where they've been before and if they've ran that type of strategy before. So say, for example, a brand new fund is coming onto the market. It's concentrating on equities listed in Asia or focused on Asia, and it doesn't have a track record. So how are you going to assess if the people behind it actually know what they're doing? Well, say jump onto LinkedIn, search for those people, see where they've been before. Have they run Asian investment strategies before? If they have, then that might give you a bit more comfort around investing in that particular product. Then finally, transparency. How transparent and open is the manager about the portfolio that they're managing? Now, the reason for this is important is because I actually want to marry up their words with their actions. You'd be surprised the amount of people that don't do what they say, or etc. So that's really important to me, and so what I'm trying to look for there is like at least the top 10 holdings in what I'm investing in. If it's a managed fund or a listed investment company, when they show me the top 10 holdings, it's historical. It's generally about 2-3 weeks old. Okay, so I can't go out there and replicate their portfolio myself. And if you do try and do that from the top 10 holdings, well, you're probably setting yourself up to fail. But I just at least want to see some transparency there and see what they're holding and if it matches up with the philosophy that I was originally sold on. Okay, now the next slide here just gives you a bit of an overview of our investment team here. This is the Intelligent Investor Analyst team. And as I've been going around the country, I think 4 people out of the 400 or so that we've seen have actually been able to pick who our head of research is, or our chief investment officer equivalent. And that person is James Carlisle. He's got a second in charge is Gaurav Sodhi. We then have a number of portfolio managers within the team as well. So what we're seeing there and what we're demonstrating there is a lot of depth and experience in the team. Now, if touch wood, if James was to step out on York Street, where he's located in Sydney, and get hit by one of the buses that goes hurtling down that street, then Gaurav Sodhi would step right in to fill his shoes. Okay, so we've got a lot of experience within this team. A lot of these guys have been with the company for a long time, prior to the GFC even as well. And so that's what I'm looking for here. So you can search all of them and see where we've all been before, and you can see there's a fair bit of experience within that team. Now, the next thing that I'm looking for here when I'm looking at an investment team is skin in the game. I don't just want someone who's invested, say, in the overall funds management company. I want someone who's invested in the actual products themselves alongside you. So when you feel pain, they feel pain. When you have success, they have success. Now, I can tell you here, a lot of our staff are actually invested in the InvestSMART separately managed accounts alongside our clients. I am one of them. All my investments are in them. And we have a number of other staff that are invested. I know because I oversee that side of the business. Now as well, we are all, pretty much all of us, shareholders in this business as well. So our interests are well and truly aligned with our clients because we are our clients as well. But how do you see if other investors, other managers that you're looking at are also invested alongside you? Well, if it's listed, it's quite easy. Hopefully you go to the top 20 shareholders in their annual report and you can see their names listed there. Now, if it's unlisted, it gets a bit trickier. You do need to take their word for it. And you can even be so brash and so cheeky if you are sitting across the table from them and just ask them for a holding statement. I know I would. At the end of the day, they're asking for you to give your money to them. So at least get them to show you a holding statement of them being invested in that specific fund. And finally, when I am sitting down with managers, I want to be bored by what I'm hearing. I want to be bored because what they're saying I've heard 1,000 times from them before. I don't want them changing their tune, and especially in the bad times. And so what I'm looking for here is when I go back through monthly reports and quarterly reports for funds, LICs, etc., this is what I'm specifically looking for, their language and how they present their reports. Now, I want to see consistency, and I want to see a fair bit of transparency here as well. I, for example, do not like funds that show you before fees returns. I like to see after fee returns. I specifically don't like funds where they show you 1 month it's before after fees and then another month it's before fees. Just remember, all these presentations, all these reports that they put out there, monthly, quarterly, etc., they're all pieces of marketing material, okay? So they're trying to present their best set of numbers for you. So I like someone who's just going to show it to you, warts and all. Now that's what I specifically look for. Now, on another note, I remember going to a particular manager's monthly report for a fund, and I knew that on the second page that I would see their performance chart. It'd be a squiggly line set to a benchmark that didn't waver. It was an absolute return benchmark. I knew that their 5-year numbers were going to look pretty bad against that benchmark once the latest year rolled off. And so what I was looking for was to see how they'd present that. Lo and behold, the next few months when I looked into it, I went to that second page, and as the numbers were starting to look bad and they were going to dip significantly below that benchmark, what I saw the performance still there, the squiggly line of their actual returns. What I didn't see was the benchmark. They'd simply just removed that. So once again, this shows you these monthly reports that you see, these are marketing pieces. Okay, you have to look for consistency within their messages, consistency with how they display their numbers, and that to me is a bit of a red flag. So just keep that in mind when you're looking through these. Now, so just to sum up, what I'm looking for when I'm looking at the people, I'm looking for their experience. I'm trying to assess key man risk as well. I want them to be invested in the products alongside you, and I want a consistency in their presentation and what they're telling you. Okay, there's some core things. Not much to ask for, is it? So moving on to the actual investment process. Now, what really frustrates me when I go out there and see managers and talk to them about their investment process is when they trot out the same old lines to me. So for example, you ask someone how they invest and they tell you we're a top-down, bottom-up value manager. Well, that's kind of really told me nothing about what you do. What that piece of jargon tells me is they top-down, they look at macroeconomic analysis, bottom-up, they look at actual fundamental analysis of the stock, and value, they try and buy it for less than what they think it's worth. Now, if every fund manager out there who says that they follow that process did the exact same thing, they'd all be holding the exact same portfolio. But I guarantee you they're not. So there's a number of different ways to value businesses. There's a number of different fundamentals to look at. And there's a number of different investment processes all round. And so that's what I want to get into. That's the kind of depth that I want to get into. So when you're looking at a process, the very first dot point I've got here is, do you understand how the manager actually invests? If you do not invest in it. Pretty straightforward. If you don't know what a long-short fund is, do not invest in a long-short fund. If you don't know how derivatives work or can barely say the word like me, then do not invest in a fund that uses them. Now, my last dot point on this page is, how can you actually tell if a manager's process is robust and repeatable? Well, time tells me that. Basically, if I'm looking over their track record, and I know the long term does smooth out shorter term fluctuations, but what I'm trying to see here is how they've navigated different economic events to show that their process can take that in its stride. but also the longer it is, the more just general business cycles. So analysts, they're all very ambitious people. They want to be portfolio managers. They want to be chief investment officers. So they'll move on. But if you've got a strong, robust, and repeatable process, even say chief investment officers, as my previous example, they move on. So if they've got a strong, robust process there's no reason why those performance numbers shouldn't continue on as they have been before. So that's how I can tell if a process is actually robust. And I'm not just looking at the one fund. Look at 2 or 3 other funds that if they do manage them, of course, that manager has under their belt. And if they've been able to roll out a strong process across all 3 or 4 or 5 or however many it is, they should all be performing pretty handily over the long term. Now, this next slide, I'm going to go into the level of detail that I like to see in our investment process. Now, I'm going to go through our specific one here at Intelligent Investor to give you a bit of an idea of that level of detail. Now, there's 2 quotes here, one by Charlie Munger, and the other one really is called The Man with a Hammer Syndrome, and it kind of really encapsulates how we think about investing as a whole. Now, for us, there is no one-size-fits-all approach to investing. We do not get one valuation formula and jam data through it. We do not use a preset filter across the market to whittle down our investing universe. What I mean by that is we don't say put a set target of 10% return on equity with a maximum net debt to equity ratio of 50%. And then put that across the market and do a scan and take 2,000 stocks down to 100 stocks. We're not going to do that. For one, it's telling us what the metrics were in the past, okay, from their last report. But secondly, it's from those opportunities that people have passed up from a scan like that we can actually find future investment opportunities. Some of our best investment ideas aren't always the prettiest companies. Okay, we do like to get out there, turn over the rocks, do the legwork to uncover those investment ideas and to uncover overlooked value. Now, when it comes down to the Charlie Munger quote, he's referring to different mental models that he has, and different mental models are ways of solving different day-to-day or investment problems. And so that brings me on to our next slide, where I say what our team do is they look at stocks sector by sector and company by company. As I said, there's no one-size-fits-all approach to this. And the last dot point on this page is really important. It says greater time is spent in understanding the key drivers of the business and the industry and what it'll look like in 5 to 10 years' time. We would rather spend more time on that than what we would looking at that 12-month price target and trying to get it right to the closest half a cent. We're not interested in what the price is going to look like in 12 months' time. What we're interested in is thinking about that business and understanding that business and its key drivers for the next 5 to 10 years. Now, a really good example of how we put this into practice, or that we practice what we preach. Our average holding period across the Intelligent Investor Growth and Intelligent Investor Income portfolios is approximately 4 years. So you can see we do think about stocks for the long term. Now, I did say that we don't use a one-size-fits-all valuation method. The reason for that is because some companies are going to suit a particular valuation method and some companies aren't. It doesn't mean that they're not worthy of investment, of course. But when all things are equal, we will use a discounted cash flow method. But saying that, what we want to see is companies that look cheap on a number of different metrics, like your very simple ones, like your PE ratio, your price to book, etc. We want to see these screamingly obviously cheap to us on a number of different metrics. Okay, so that's what we're using when we're looking to value businesses. Now, there are a few key ratios across the number of different sectors that we do look for as well. I won't dwell on these, but if you do want a copy of these slides, put your email address in the question section and send it through. Of course, we won't publish it, You can see here we've got banks and infrastructure stocks as well on the next slide. Now, I did say we do not use, we do not dwell on things like net debt to equity, like gearing, but it is a red flag to us. As a general rule of thumb, we don't like stocks that have 50% plus net debt to equity. However, it's not an instant no. It's a red flag, and it's something that we want to look at, delve into, understand, get comfortable with it, and move on. Or understand, not get comfortable with it, and move it aside. So then finally onto the next slide here, overlay things with a checklist. This is what all of our analysts do. We all have our own checklist. I inherited one from the Intelligent Investor team, and I think it's about 36 pages. So it's really detailed. And the reason why I really encourage all investors to use a checklist, no matter if it's you're looking at investing in just a standard managed fund or in individual stocks, it's because it forces you to think about the smaller things that you might not always think about. Now, on the second page of the checklist overlay here, the last dot point is really crucial to our investment process. It says to the worst case, what's the worst case scenario for the stock? Try and build the perfect storm. Now, why I say this is an important part of our process is because what we do is when our analysts, no matter if it's our head of research, James Carlisle, or our junior analysts, when any one of them have an investment idea, they need to send the idea around to the investment team. We then organise a time and we meet up and do what they call a Dragon's Den. I don't like the name, but it's the name existed a long time before I did. So they meet up, they have a Dragon's Den, and what happens there is the person that's presenting that stock to the investment team sit down, present their case, and then all the other analysts will try and pick apart that case. So it's a very robust process. I've sat in on them, and they can sometimes go for 2 to 3 to 4 hours. And in that process, what the guys decide is whether or not something's a buy, a hold, or a sell. They'll also decide the portfolio weighting and the maximum weighting, and they'll also decide the buy-in price, the hold price, and the eventual sell price. So a lot of the time, though, the analysts are sent back with more questions to answer, and they have to go through the process again. And that's just to make it onto our website, okay, and potentially into the Intelligent Investor growth and income portfolio. So before a stock goes up as a buy, a hold, or a sell, it goes through that process. Once it's up there and we're going to look to change from a buy to a hold to a sell, it needs to go back through that process. So it's a pretty thorough vetting process that takes place. Now, speaking of that, it leads us on to our next slide here of portfolio construction. It goes through that Dragon's Den process just to make it into our Intelligent Investor growth and equity income portfolios. These are portfolios that you can invest in. I personally am invested in the Intelligent Investor growth portfolio. Both portfolios hold anywhere between 20 to 30 stocks. Currently, I think there's about 22 to 24 positions. And we run these portfolios, and this is another key part of our process. We run them almost fully invested. So at any one point in time, you're looking at the portfolios are going to be 97 to 96% invested and with very little cash. And because we hold such little cash, for a stock to make it into the portfolio, it needs to be a stronger position and showing us better upside and a bigger margin of safety or a discount to value than our weakest idea in that portfolio. So the entire idea is to try and make these portfolios as undervalued as possible. Now, you will notice that there's a number of stocks that are held in both portfolios, and that's because the stocks start with value first. Everything must be showing us good value. Now, if it's good value and paying a dividend, it goes into the equity income portfolio. If it's good value and not paying a dividend, then it goes into the growth portfolio. If it's good value and paying a dividend, and we're seeing a really deep discount to value, then it'll go into both portfolios, and hence why we have a number of crossovers in each portfolio. So you can go onto the website, onto the investment section, and actually just see the performance, the up-to-date performance, and also the estimated annual income generated by both these portfolios, which is pre-franking. I believe the equity income portfolio is running at about 4.5%, and the growth portfolio is running about 1% less when it comes to average income. Now, we're going to move on to the product side of things. So our first product that we're looking at, the first type of investment structure, is an exchange-traded fund. Handy for those people who still want to do it themselves, but might not know really where to start. If you don't know a lot about what you're doing, one thing that we do suggest is to buy everything. Okay, if you can't pick one or 20 companies out of the ASX 200, the safest option for you is to buy the entire 200. This gives you instant diversity. So say if you're looking at investing in an ASX 200 exchange traded fund, so there's 3 out there that do the exact same thing. What differentiates them? Well, for us, it's the fees and the size. The reason why I say the fees and the size, well, the fees basically is all things being equal, that ETF will underperform the benchmark that it's tracking by the cost of its fees. Okay, someone once asked me in what situation would an ETF outperform its benchmark? Absolutely never. It's not designed to do that, okay? It's designed to track the index at best. Now, there are other types of ETFs out there that track indexes of their own creation. For example, if you want to use these to play thematic investment type of cases for you, for example, you want to invest in global healthcare, you think that's a trend that you want to be exposed to, but you don't know 1 or 2 or 3 investment global healthcare names that you want to invest in, well, you can actually just buy them all. There is a ETF on the market, its ticker is drug, and that'll get you exposure to all of the global healthcare stocks out there on the market, weighted by their market cap. Now, if you wanted to do the same thing, but along the theme of, say, global cybersecurity, you can do that. And there's an ETF out there that buys into all the global cybersecurity stocks weighted by their market cap, and that code is HACK. So if you type in HACK, you'll be able to find that particular ETF. So there's an ETF out there to basically do almost everything. If you want gold exposure, commodity exposure, just exposure to the banks themselves, you can do that. Now, one thing, there's a lot of smart beta ETFs as well. Smart beta means they're running to a very specific set of rules that they've created. Say, for example, the income side of things is really interesting there, where you've got ETFs that are trying to do enhanced income for people. Now, there's they create a series of rules to select stocks to invest in these higher income paying stocks, and you can invest in them. However, one thing that we certainly think of is that investing is more of an art form than a science. And these rules, the good thing about investing with a rules-based philosophy is you have to follow the rules. The bad thing about investing with a rules-based philosophy is you have to follow the rules. So we'd rather not invest in those. But also with when it comes to these smart beta ETF portfolios, the more elaborate the rules, that sometimes the higher the costs associated with them. A lot of people generally think of ETFs as cheap. That can be the case with the basic index tracking ETFs, but maybe not the case when it comes to some of these smart beta ETFs. So believe it or not, ETFs do have to produce an annual report. They are incredibly boring to read. But one thing they will show you is the management expense ratio. So that's the cost of the management fees and expense fees to you as the end user. Now, how you can quickly do this calculation is just grab the total assets and divide it by the total expenses. That will give you the MER, the management expense ratio. So just keep an eye out for that. Naturally, people assume ETFs are cheap. sometimes not always the case. Just be aware of what you're paying, because at the end of the day, as the user, you pay for everything. Now, moving on to listed investment companies, and the word company here is really important, okay, because the company means it's a closed-ended structure, but also the company means that it can actually smooth out dividends and income for you. Now, an ETF and a managed fund, because they're unit trusts, need to pay out all income earned, okay, to their members. Now, a listed investment company can retain profits in its profit reserves and look to pay them out over a number of years, so they don't have to pay everything out at once. And why that's important? Well, look back through the GFC and look at listed investment companies like AFIC, Argo, Milton, BKI, etc. What they were able to do, and they've done this for decades, is slowly pay out an ever-increasing amount of dividends. So that dividends per share, or cents, dividends per share have been growing year on year for these stocks, even through the GFC. That's because they've been able to use their profit reserves effectively. Okay, that's a really big differentiator between managed funds and ETFs to listed investment companies. Now, the other reason why the word company is important is because it's a closed-ended structure. So basically, you raise the money once from an IPO, and you've got it locked in there for the length of the contract. Now, think about this. These are why you're seeing a lot of listed investment companies coming onto the market at the moment. You go out there, you raise $100 million, you charge 1% on that, and you can charge plus performance, and you don't pay any of the listing costs. The shareholders pay the listing costs, but you've got this basically a client. That portfolio is a client for you as a fund manager that's locked in for 10, 20 plus years, and they're paying you 1% per annum plus the performance upside. What a wonderful client to have as a fund manager. So you can see why that closed-ended structure is really good from the fund manager point of view. Potentially not so good from the shareholder point of view. Now, where a closed-ended structure can be a plus comes when, say, you're investing in illiquid assets, or you're, say, investing in a small cap portfolio where you want to put together a strategy for the long term, where you have to really think, where you want to think about putting together a portfolio for the next 5 years and not have to worry about money coming in or money coming out, more importantly as well. For example, we recently did a write-up on Bailador, BTI. It invests in unlisted IT companies. Now, unlisted companies are highly illiquid. It's very difficult to get in and out of them. So a listed investment company structure is one of the better structures to be able to invest in those, because if you as a shareholder want to come and go, you can. You just find someone else to sell your shares to, and away you go. Now, the other thing you need to do to keep in mind about listed investment companies is the fees and expenses. This is why you want to buy them at a discount to net tangible assets. Essentially, you're buying $1 for 80 cents. Now, on the inverse though, you can get the opportunity to sell a listed investment company, sell $1 for $1.20. But for some reason, people are happy to buy $1 for $1.20 out there. I don't know why. But why we're always trying to get these at a discount is to make up for the fees and expenses, because you pay everything. Managers are generally always very happy to tell you about their management fees. What a lot of the time they don't tell you about is the additional expenses that can add up, and especially the smaller the portfolio. The smaller the portfolio, the higher the expenses. So thinking about the management expense ratio again, get the annual report of a listed investment company that you're looking at and do that quick and simple calculation to get your MER. And that's what you really should pay attention to. Not the fees that they just tell you about, but absolutely everything, because you pay it at the end of the day. Now, this next slide starts to look at a bit, is why I'm slightly not negative on LICs, but it's something to be a little bit wary of and just to keep it in mind. Now, this slide shows the top 20 listed investment companies by market capitalization. You've got AFIC at $6.5 billion, you've got Argo at $5 billion, you've got Milton at just under $3 billion, and then you've got WAM, and then you've got everything else a distant fourth or fifth. Now, the reason why this slide is important is because the next one, listed investment companies by average daily volume traded. These are highly liquid stocks. If I was to put Telstra or Woolworths, etc., up alongside this, their average daily turnover would dwarf what you're seeing here. So you've got Wilson Asset Management there at WAM Capital, you've got Future Generation Fund, and then it really just dies away. So this is important to think about when, if all of you out there went to buy one LIC and into the same LIC this afternoon, you wouldn't all fit through the door. Bigger issue when you're all trying to get out the door. Now, whilst I'm still on the subject, there's a lot of LIC IPOs out there right now. I particularly am not a big fan of IPOs for two reasons. One, you pay the listing costs. Okay, so you buy into it for $1, but then they have to that pool of funds needs to pay out everyone else that helped list the fund. So basically, you pay $1. The NTA, the net tangible assets, the actual value of the underlying portfolio, will come onto the market at approximately 97 cents or thereabouts. So instantly, from the word go, you are down. Okay, so you're behind the 8 ball straight away. Now, of course, a lot of them will give you an option, a bonus option, a loyalty option, whatever they want to call it these days. But they'll give you an option, and that's to make up for instantly being behind the 8 ball. But what that option does is put an artificial ceiling on the share price. Now, what I mean when I say by that, say for example, you listed $1, the share price goes to $1.10. Everyone's got their options at $1. Okay, and a lot of people think, oh, geez, I'm going to exercise my options, and because the share price is at $1.10, that's an instant upside. They exercise their options. More cash goes into that portfolio at $1, and it brings the net tangible assets down. It dilutes the NTA, so it creates a natural ceiling. I'm more interested in LICs once those options are about to roll off, okay, because it takes away a secondary market for investors to invest in, and it takes away that artificial ceiling. So that's when I'm slightly more interested in listed investment companies. Now, onto the next slide here, and we're touching on managed funds. I'm going to sound like a broken record when I say keep a close eye on fees, but just remember you are paying everything at the end of the day, and these eat away at your returns. Okay, it's very, very important to focus on them and to look at your management fee, look at the performance fee, and look at the expenses. Add it all up. Now, when you're investing in a managed fund, just remember you own units and not shares. You're in a pooled investment with all the other investors in that product. And so basically when you look to sell a ETF on the market or an LIC on the market, you're not going to get a phone call from anyone. But when you want to sell units in a managed fund, you need to send in a redemption request. And if that company is any good, they're probably going to be on the phone to you, asking you why you're leaving, or just giving you a friendly tap on the shoulder, asking you if you're sure. Now, also managed funds are open-ended structures, so money can flow in and money can flow out at any point in time. Now, from my experience, a manager will typically receive the most amount of cash coming into their fund when they can least spend it. So that's when the market's really buoyant, everyone's really happy about the market, happy about the returns they've received, and they're talking about it with their mates, they're talking about it at barbecues, etc., and they're happy, it feels good to give fund managers cash. Okay, a value manager especially cannot spend that money at that point in time, and if you're already invested in that portfolio, it's actually, that manager becomes a forced seller in an expensive market. In the long run, you're going to pay for it. Now, on the inverse of that, when a manager receives the most amount of outflows is actually when they can spend the money the most, when stocks are cheap, when the market's fallen, when it feels bad to be invested. That's when value managers are rubbing their hands and they're dancing to work. There's a saying out there, invest when there's blood on the streets, even when it's your own. And that's what managers want to do. But that's when their hands are tied because they're generally getting a lot of redemption requests coming in. And if you get a lot of redemption requests as a manager, you're actual forced seller to keep up with the cash outflows in a time when you really want to be buying. Now, if you're a unit holder there and you're happy to hang on, your investment will still be impacted because they'll be liquidating shares at the bottom, and you will be impacted over the long run. So that's really important to keep in mind. Now, onto the final slide. This is the final investment product we'll take a look at today. We specifically choose separately managed accounts to run our portfolios. These are often shortened to SMA. Now, they are not pooled investments. The S in SMA is very important here. It's a separately managed account. So your stock is your stock. The other investor's stock, it's theirs. Another investor's stock, their stock is their stock as well. You're all separated, okay? And you actually have full beneficial ownership of the underlying investments. So you own that stock. And if someone else wants to come and go, they can. They will just sell their stock, not yours. It's much more tax efficient for you as well. But really important to us is how flexible separately managed accounts are when it comes to receiving income. So, for example, and this is really important for a lot of our clients who are in pension mode in their self-managed super funds and they're drawing on their portfolio. So basically, why we chose these is because you can take income any way you want. So for example, if our stocks pay dividends and we also receive interest on the cash, every month you can have that income instantly swept to an account of your choice. Also, you can set up monthly, quarterly, or whatever frequency you like, drawdowns of a certain set amount. Say if you need, your living expenses are roughly $4,000 a month or whatnot, you can have that set up in your portfolio and you can be drawing down on it. Now, also you can then take ad hoc payments, holidays that come up or you need a new car, etc. You can take those ad hoc payments as and when you want them. You just need to notify us. And you can do a combination of all three. And of course, all the franking credits as well, incredibly important, go directly to you once you put in your tax return. So that's why we really choose to operate these separately managed accounts, and because they're quite cheap for us to run as well. They're good for you, and we pass on the savings to our investors. Our management fee is 0.97% per annum, and that's where it starts at, and it goes down, and we don't charge performance fees. So the separately managed accounts, and that is specifically why we use them. Now, whilst I've been going through all this, I hope you've been sending in questions. If you haven't sent in any questions, but you do have some on your mind, send them in right now, because I'm about to jump off from my presentation and go into those questions, and we'll see what people have sent through. You just bear with me for 1 second. We do have quite a few questions. Let me see. Okay, Bailey says, I have noticed that some of the holdings in your portfolios are listed as holds. Why not buy? I presume Bailey is referring to here, maybe we've got some holds in our portfolios that people buy into actively. As in, when you do invest in one of our separately managed accounts, once your funds are cleared, that day they'll go out and buy all the stocks in the portfolio. Why do we buy the holds? Well, there's still a lot of potential upside in our holds, just not a big, deep discount to value, not a deep margin of safety there to put a buy recommendation on it. But it doesn't mean that stock still won't continue to grow and add value down the track as well. So our holds are definitely still worth buying into. Now, a lot of people say, is it better for me to maybe buy into the intelligent investor portfolios as an SMA? when there are more buy calls than there are hold calls? Well, naturally that would make a bit more sense, but when that is going to be, we don't know. So for people who are wanting to, say, time their entry into these portfolios, perhaps it'd be better to start with a nominal amount and then just add over time in gradual increments. That could be a better strategy. I hope I've answered that question there, Bailey. Now, Terry says, what are the fees for a separately managed account? Are there performance fees? Terry, I hope I answered that just a couple of short minutes ago. I said 0.97% per annum is the management fee, and then it actually goes down to 0.65% per annum. The only other expenses that you will pay are brokerage, and brokerage is incredibly cheap. It is 33 cents a trade plus 0.05% of the traded value. So when you actually work out that calculation, say if we, I did it earlier, if we bought $10,000 of one stock for you, okay, you'd have 33 cents for the trade, and then the actual 0.05%, it'll work out to be $5 for the trade. $5 plus 33 cents, so $5.33 to buy 10 grand worth of stock. I hope that covers that question. Harold says, when you say that the portfolio receives income, does that mean that each investor has a cash balance in the portfolio until this is drawn down or reinvested? Correct. So the income goes back into the cash component of your portfolio. All the portfolios have cash components. For example, this is just off the top of my head, so if it's not 100% correct, forgive me. The Intelligent Investor Growth portfolio is about 96% invested, or maybe 95% invested. So of course that other 5% is going to be held as cash. The overall separately managed account as well, SMA, will have a minimum cash balance of 2%. Okay, that's so we can draw down our fees and pay the expenses. Now that's the fees are calculated on a monthly basis. A daily basis, and charged monthly in arrears from the cash account. So there's always a cash account in your separately managed account. The dividends go back into it. If you choose not to have them swept out into an account of your choice, then the dividends will be reinvested into the portfolio when we rebalance. Okay, it is not necessarily reinvested into the stock that was paid from. We want to choose which stocks they go into. So when we rebalance the portfolios, that's when your dividends will be reinvested. Otherwise, if you have, say, a monthly drawdown, they'll be swept out each month for you. I hope that answers that question, Harold. Peter says, what do you think of Warren Buffett's idea of investing in low-cost index funds such as Vanguard's S&P 500? I think it's a great idea. If you do not want to spend the time or have the skill or the will to invest, and you don't want to go out there and, say, try and handpick a few managers to potentially outperform for you, then index funds are becoming more and more popular, and it's an easy set and forget strategy. But when you are looking at just investing in index funds, make sure you're diversified. Now that is why with our InvestSMART diversified portfolios, we don't try to be too clever. What we do with those is we invest in ETFs, but we invest in a diversified portfolio of ETFs. Okay, so it's not just 100% in the ASX 200, it's not just in the S&P 500. And we've got a diverse portfolio there of a number of different ETFs across a range of different asset classes to give you a nice, moderate, balanced return or a growth return, targeting a very specific percentage above the RBA cash rate. Okay, so that's one thing I would say to index investors. And also the importance of rebalancing as well. Say if the ASX 200 runs and becomes a much higher percentage of your portfolio, don't be afraid to trim that and put it into some undervalued or underperforming asset classes because just for sake of diversification. Let me see. Raj says, can you please name some gold exchange traded funds and not gold, G-O-L-D, and international bank ETFs? Raj, off the top of my head, I cannot name specifically some gold ETFs other than gold, which GOLD is the code for physical gold. I know the Perth Mint have one. But I'll tell you what, if you send through your contact details, I can definitely find them for you. International bank ETFs, I can guarantee you there is ones out there, but I just off the top of my head, you've caught me on the hop there. I cannot tell you. So there's a couple more questions here. They've just come through. They need to be just published. I'm just going to publish them here. Let me see. So I'll just publish all of these and then we'll get straight back onto them. Okie doke. So, all right, we might have seen quite a few questions just pop up. Jeannie asks, Janine, I think it's Janine, asks what sort of identity requirements are needed to apply for an SMA. Also, who do I contact if I have any technical difficulties? Identification requirements is quite straightforward. It depends on what entity you're investing in, say your personal name, if you're individuals as trustee for your super fund, or if you're a corporate super fund, or if you're just joint, husband and wife looking to invest. At all times, of course, have your driver's license with you or your Medicare card. But all of this is done online. So you just hit the apply now button on whatever investment it is you want to start off with. And then you'll be taken through to a section where you can fill out your details, and then we'll actually verify you online. So it'll ask for your tax file number, it'll ask for your driver's license number and your address. It'll match you up to the electoral roll. With your superannuation fund, have your ABN and TFN for the super fund there, and we'll be able to match you up. So all of this can be done online, but just have all those details ready with you before you start it. Okay, you don't want to go in there, realize you need to go and get a few things, completely forget about it. 3 months goes by, you come back and the portfolios have done a few percent, you've missed out. So just make sure you have all those details with you before you do start. If you have any technical issues, just give us a call here or email invest@investsmart.com.au and we can take care of you, no problems whatsoever. Dennis says, is it possible to transfer holdings in, not just out? Yes, you can do what is known as an in-specie transfer. You can transfer your stocks into the portfolio. That's a good thing to have in place there. The reason for that is if you've been following along the Intelligent Investor calls for a long time, but you want the team to take over the full management of the portfolio, you probably have a lot of stocks that they've been recommending and that are in the portfolios currently. So if you transfer them in, that'll lessen the amount that we need to say buy for you. We might need to trim a few to bring them in line with weight, but it's a good way to start. Just be wary that when you're transferring stock in, typically brokers will charge a transfer fee of approximately $50 or so per line of stock. So just keep that in mind. It may even work out to be cheaper for you just to buy, to sell and then to transfer cash in and start again. So just see which works out best for you there, Dennis. Steve says, do you complete some form of tax documentation for the separately managed account? We send out comprehensive tax statements at the end of each financial year. So you just can forward those straight on to your accountant. They're really straightforward. And if you are transferring stock in, we'll ask for the cost base of that stock so we can get the tax details as accurate as possible for you. So we definitely, if you are transferring stock in, need the cost base of those holdings. Let me see, Reese says, I looked at your portfolios recently, but it appears some are now gone. Am I imagining things? No, Reese, you are not. The reason we have taken some portfolios off the website, that's because we're consolidating them. You might have previously seen that we had, say, the Intelligent Investor Growth Portfolio, the InvestSMART Growth Portfolio, and the InvestSMART High Growth Portfolio. We have removed the InvestSMART High Growth Portfolio. The InvestSMART Growth Portfolio is now our core portfolio. and the Intelligent Investor Growth Portfolio is still there, of course. The reason why we did this, someone comes onto the website and says, well, I just want growth. What am I? And so we've just decided to consolidate these. Some new features will be coming. Those people who are currently invested in the InvestSMART, say, high growth portfolio, what we're doing is moving them towards the core portfolio and then increasing the equity exposure for them so they still have their high growth asset class. And also, I mean, the conservative portfolio and the income portfolio, for example, as well, were actually very, very similar in their holdings. So we've actually just removed the conservative portfolio altogether. If someone was originally invested in that, they'll get the core portfolio, and then we increase their fixed income and cash exposure to get the asset class back to what they're originally at. I hope that makes sense, and I hope that's logical for you as well, Reese. One thing we've been able to do, and we're just getting this out now, is also lower the fees because of this consolidation on the InvestSMART diversified portfolios. So our ETF portfolios, instead of starting at 97 basis points, 0.977% per annum, we're taking that down to 77 basis points, 0.77% per annum. So that's another good reason for the consolidation as well. I hope that makes sense. Gareth says some portfolios say income per annum far below your quoted performance. How does this work? Well, Gareth, the quoted performance is total return. So that's growth plus income. So then that's what we really do try and focus on here. But of course, we know that a lot of investors really care about what income they're receiving. And so that's why we have an estimated income per annum, so actual dividends paid to you. But the actual returns are total returns, so what we've got in growth and income, because we think both are very important. So it looks like I've gone through all the questions here. Thanks for joining us, and we will catch you next time on another InvestSMART Smart Investor session. Thank you.